Zombie ships, why global shipping is even worse than the Baltic Dry suggests. One glance at the Baltic Dry Index's collapse is all that most need to see the painful state of the global shipping industry. However, as G-Captain reports, reality is even worse as the boom in so-called zombie ships suggests there is no recovery in sight for the beleaguered containership charter market, which is facing its biggest crisis since the 2008 financial crash. And it's not just oversupply. Trade is slowing rapidly. World trade volume rose by only 0.5% YoY in October and was up 2.4% YoY in the first 10 months of 2015, while world trade value in US dollar terms declined by 12.2% YoY in October and was down 11.8% YoY in the first 10 months of 2015. Analysts agree there is no recovery in sight for the beleaguered containership charter market, which is facing its biggest crisis since the 2008 financial crash. However, unlike that bleak period for shipping, which ultimately resulted in a strong recovery for charter rates, this time the fundamentals are quite different. Overcapacity, stemming from the ordering strategy of carriers, has been exacerbated by a growth slowdown in China and ultra-low oil prices. And according to the latest report from Alphaliner, with the possible exception of very small feeders, all containership sectors are struggling badly, with owners obliged to accept sub-economic charter rates and pay for positioning costs just to keep their ships busy. The revenue earned in charter hire is seen by owners as a contribution to vessel overheads, but is often insufficient to cover mortgage payments on the ship. Thus zombie ships, as they have become known in shipbroking circles, are masking the perilous state of container shipping. Commentators generally point to laid-up tonnage and ship deletions as health barometers of the industry, but in the past year, these have proved to be less than reliable as indicators. Despite chronic overcapacity and weak demand, the number of laid-up containerships has only inched up relatively, with Alphaliner's idle tonnage register at January 11 reflecting a net increase of just 6 ships in the previous 2 weeks. In fact, the total number of idled ships, 337, 1.35 MTU, represents only 6.8% of the world's cellular fleet, a figure that is clearly artificially low given current industry fundamentals. While some smaller ships were added to the laid-up fleet during the period, Alphaliner notes that several ships of 7,500 TEU and above were returned to service ahead of the Chinese New Year holiday, albeit that after the peak pre-CNY weeks these ships are again likely to become surplus to carrier requirements. The demand for 7,500 to 9,500 TEU ships is next to zero, said Alphaliner, adding that there are still 12 vessels of 7,800 to 8,800 TEU seeking employment in Asia. As we noted previously, given these trends, the crummy performance of our heavily internationalized revenue-challenged corporate heroes is starting to make sense. It's tough out there. And further, as the Baltic Dry Index continues to plumb new record lows, how long until central banks realize that for all their omnipotence and all their attempts to restore growth, inflation, and the wealth effect, they never mastered the only thing worth printing in a globalized world: printing trade? Global shipping contends with oversupply problems. Summary: the global shipping industry is oversupplied. Because supply far exceeds demand, shipping rates have plummeted, as have the prices of ships. Some shipping companies have sought to capitalize on this trend by purchasing newer, larger ships at lower prices so that they can remain price competitive. But unless demand rebounds by the time these ships become operational, the industry's oversupply problem will only worsen. It is unclear whether the global shipping industry will normalize before these new ships enter the market. Demand could rise as the global economy recovers, or the supply of ships could somehow fall. But the economy's recovery could just as well be slower than anticipated. Several factors could prevent the industry from righting itself, not the least of which are inaccurate forecasts of future market behavior. In fact, the current state of global shipping was caused in part by incorrect predictions of continued growth prior to the 2008 financial crisis. In any case, continued poor performance in a sluggish global economy could eventually force the shipping industry to restructure. Analysis: the most important factor to consider, in assessing the state of the shipping industry, is the state of the global economy. The international shipping industry accounts for approximately 90% of global trade by volume and is essential for connecting large sectors of the world's economy. Since 1734, the industry has seen more than 20 boom-bust cycles, which occur roughly once per decade. The most recent cycle began in 2004 and peaked in 2008 before declining rapidly at the onset of the global financial crisis. The downturn afflicted each of the industry's three main categories: tanker, dry bulk, and container. While the volume of global trade has recovered somewhat, it grew 4% in 2011, marking a 16% growth in ton-kilometers. The shipping industry is still reeling from the financial crisis. Big, efficient fleets. The industry right now has far more ships than it needs. Most shipping companies tend to reduce the price of their services in an effort to underbid their competitors. Either they reduce the cost per ton or the cost per container. This means most companies try to accrue the biggest and most efficient ships possible. Between 2007 and 2012, the average container ship's capacity increased by 27%. From a shipping company's perspective, overstocking a fleet with large ships while prices are low is a sound business move. Ships are long-term investments that can yield returns for 20 or 30 years, and trade will almost certainly pick up during the lifespan of any given ship. While purchasing new ships may seem counterintuitive in an oversupplied market, companies know that the capital cost of a ship plays a disproportionately large role in determining how profitable that ship will be, representing roughly half of all expenditures including port fees, labor, fuel, and other costs over the course of the ship's lifetime. Buyers therefore take advantage of low prices whenever they can. The more efficient these ships are, the lower the price their owners can offer to potential customers. Maersk Shipping Company recently christened the first ship in its Triple E line, which is now the largest line of container ships in the world. These ships are a quarter of a mile long, and they can hold roughly 11% more cargo than their nearest competitors. Overcapacity is a problem in itself, but the issue is complicated by the inherent lag in acquiring inventory. On average, it takes 2 to 4 years after the placement of an order for a ship to be built and delivered. Thus, ships ordered in 2008, when the industry began to decline, were not delivered until well after the financial crash. While shipping companies had hoped the economic downturn would end quickly as many had forecast, they could not afford to let their competitors build superior fleets. They were forced to continue buying just to stay competitive. An informal alliance. Along with the economic downturn, the contest to outbid competitors helped keep shipping rates low. In turn, low rates have forced shipping companies to work for fees that often cover only the operating costs of the ships. In these instances, companies that are still paying off the capital investment of the ship are actually losing money. This is notable, considering the Drewry Global Freight Rate Index dropped more than 30% from July 2008, $2,727 per 40-foot container, to May 2013, $1,882 per 40-foot container. The threat posed by untenably low rates could transform the shipping industry. The world's three largest container lines, Maersk, CMA CGM, and Mediterranean, have formed an alliance of sorts in an effort to reduce operating costs. The fact that the three largest companies in the industry are acting in concert indicates just how hard it has become for them to survive the downturn, to say nothing of smaller, poorer companies. Their informal alliance could portend further consolidation. Past consolidation efforts to control shipping prices were unsuccessful, but several outstanding issues, such as China's slowed growth and the European crisis, may keep global demand low enough to force the industry to restructure itself. In previous boom-bust cycles, demand and shipping rates rebounded as new ships became operational. It is unclear whether this will hold true in the current cycle. If it does not, newly acquired ships will only aggravate the industry's problems. Economy, financial crisis. International shipping shuts down, Baltic Dry Index free falling. International cargo vessels today are all docked and anchored in most seaports all over the world, and the last trips they may have had were for the December holidays shopping spree. As of yesterday, the most prominent global indicator for international shipment of physical goods, the London-based Baltic Dry Index, is in free fall. For the last 6 months or so, most cargo container ships were already sailing with less than their full capacity. The physical economy is crashing, and all the warnings that's been relayed to you for the last 4 years should have prepared you for what's to come in the interim. There may be a short disruption on the supply of critical goods and services, especially on areas that are fully industrialized. Today, Monday, January 18, 2016, the Baltic Dry Index decreased by 4 points, reaching 369 points. Baltic Dry Index is compiled by the London-based Baltic Exchange and covers prices for transported cargo such as coal, grain, and iron ore. The index is based on a daily survey of agents all over the world. Baltic Dry hit a temporary peak on May 20, 2008, when the index hit 11,793. The lowest level ever reached was on Monday, January 18, 2016, when the index dropped to 369 points. Source: Hellenic Shipping News Worldwide. The Baltic Exchange's main sea freight index, which tracks rates for ships carrying industrial commodities, continued its freefall to close at a record low on Tuesday amid concerns over vessel oversupply and global demand shortage. The overall index, which gauges the cost of shipping dry bulk cargoes including iron ore, cement, grain, coal, and fertilizer, fell for the 11th straight session and was down 6 points, or 1.63%, at 363 points. The index has plunged 115 points, or around 24%, in January. The Capesize, Panamax, Supramax, and Handysize indices also continued their downward spiral and touched their all-time lows on Tuesday. The dry bulk sector has taken a beating from the slowdown in Chinese business at a time when the sector is struggling with huge overcapacity. The Capesize index fell 12 points, or 6.09%, to 185 points. Average daily earnings for Capesize vessels decreased by $68 to a new record low of $2,662. Capesizes typically transport 150,000 ton cargoes such as iron ore and coal, and have been particularly affected by a fall-off in coal and iron ore demand in China. The Panamax index fell 6 points to 369 points. Average daily earnings for Panamaxes, which usually carry coal or grain cargoes of about 60,000 to 70,000 tons, fell $47 to $2,952. This unfolding event in the physical economy is reminiscent of the event back in the early part of 2012 when CEOs of global banking resigned en masse. Massive resignations have started. This is one more proof that the plan to end the Great Con game perpetrated by the Hazarian Mafia for centuries will be terminated this year as much as possible. Earlier, China had instructed its banks to stop buying US dollar and instead gradually unload its dollar reserves. The Chinese central bank also demanded that the yuan will be the only currency they will accept and honor from here on, with the exception only where sovereign currency swap agreements are in effect. This means that those countries which don't have such similar arrangement with China will suffer financially unless their currencies are proven to be backed up with hard assets. This is a very smart move of ridding out the imaginary wealth of Western oligarchy. An event like this is not something the Hazarian co-opted mainstream media would like to talk about. More evidence of the shutdown of international shipping from Zero Hedge. Nothing is moving. Baltic Dry Index crashes as insiders warn international commerce has come to a halt. By Tyler Durden. Economy crisis. The continued collapse of the Baltic Dry Index remains ignored by most. Besides, we still have Netflix, right? But, as dollar vigilantes Jeff Barrick details, it appears the worldwide real economy has ground to a halt. Last week, I received news from a contact who is friends with one of the biggest billionaire shipping families in the world. He told me they had no ships at sea right now, because operating them meant running at a loss. This weekend, reports are circulating saying much the same thing. The North Atlantic has little or no cargo ships traveling in its waters. Instead, they are anchored, unmoving, empty. You can see one such report here. According to it, commerce between Europe and North America has literally come to a halt. For the first time in known history, not one cargo ship is in transit in the North Atlantic between Europe and North America. All of them, hundreds, are either anchored offshore or in port. Nothing is moving. This has never happened before. It is a horrific economic sign, proof that commerce is literally stopped. We checked vesselfinder.com and it appears to show no ships in transit anywhere in the world. We aren't experts on shipping, however, so if you have a better site or source to track this apparent phenomenon, please let us know. If true, this would be catastrophic for world trade. Even if it's not true, shipping is still nearly dead in the water according to other indices. The Baltic Dry Index, an assessment of the price of moving major raw materials by sea, was already at record all-time lows a month ago, and in the last month it has dropped even more, especially in the last week. Today BDIY hit 415. Factories aren't buying and retailers aren't stocking. The ratio of inventory to sales in the US is an indicator of this. The last time that ratio was this high was during the Great Recession in 2008. Hey, Ms. Yellen, what recovery? The economy is taking on water at a rapid rate. The storm has been building for some time, actually. Not so long ago, there was a spate of reports that the world's automobile manufacturers were in trouble because cars were not selling and shipments were backing up around the world. Zero Hedge reported on it this way. In the past several years, one of the topics covered in detail on these pages has been the surge in such gimmicks designed to disguise lack of demand and end customer sales, used extensively by U.S. automotive manufacturers, better known as channel stuffing, of which General Motors is particularly guilty and whose inventory at dealer lots just hit a new record high. Here is a photo of unsold cars in the United Kingdom from that article. The world's economy seems in serious trouble. You can't print your way to prosperity. All you are doing is hollowing out your economy. Draining it. And sooner or later it's empty and you have to start over after a good deal of crisis and chaos. It's no coincidence that China is struggling desperately to contain a stock implosion. Reportedly, banks have been told they are forbidden to buy US dollars and numerous Chinese billionaires have gone missing. And the markets have just opened on Monday and are again deeply in the red. Here at the Dollar Vigilante we've specialized in explaining the reality of the global faux economy and why it's important that you not believe mainstream media lies. In the meantime, keep your eye on this shipping story. If it is true and worldwide shipping is disastrously foundering, it'll only be a matter of days before grocery store shelves will reflect that with increasingly bare shelves. Are people upset now? Just wait. Interruptions in goods and services, most critically food, almost happened in 2008 during the Great Financial Crisis. For 3 days worldwide shipping was stranded due to shipping companies not knowing whether or not the receiver's bank credit was good. That crisis was staved off due to a massive amount of money printing. It was a temporary stay of execution, like bailing out the Titanic with coffee cups, however, and one that may reach much larger proportions in 2016. Sailors watch the weather to see if it is safe to set sail. Investors should be watching the economic climate with the same intensity. We are already sailing through very stormy waters. Perhaps the most dramatic, and underreported, new aspect of this ongoing struggle has been the freeze on global shipping. To confirm reports on the internet of a shipping freeze, this writer called NYK Lines, a major international shipping firm, and was told we cannot speak for the whole world but, as far as our company is concerned, with current shipping prices we will lose money every time we send a ship so we have stopped. Chinese government sources told this newsletter shipping companies are now demanding to be paid in Chinese yuan and not dollars and that is a major reason for the freeze in shipping worldwide. If this continues, it will lead to empty supermarket shelves and social unrest, especially in the US. The announcement last week by Walmart that it is closing 269 stores is just the beginning. One of the significant sources of funds for the Nazionist Hezaryan mafia is the healthcare industry, which registered a whopping $3.09 trillion in 2014, and is projected to soar to $3.57 trillion in 2017, in the US alone. We believe that this is just a conservative figure.